Good afternoon, everyone, and welcome to the Supply Chain Solutions Weekly Ship Show. Today is November 18th, 2021, and this is episode number 26 in our weekly educational series that keeps you informed of the ebb and flow of the changing market conditions during the great supply chain disruption of 2021. And as always, it is my pleasure to welcome my Ship Show co-host, Jason Brand, our Director of Business Development, who joins us each week on our broadcast. And finally, my name is Anthony D'Ambrosio. I'm the Vice President of Business Development at Supply Chain Solutions, the company that always strives to find a better way and deliver results. And as usual, we'd like to thank our amazing Director of Marketing, Vanessa Fry, for producing today's show. So, besides our global freight market update that Jason will be talking about today, we have what I think is a very interesting topic for today's program, folks. And that topic is why shipping's extreme consolidation could prolong the supply chain crisis. So I think it's important to note that U.S. policymakers have never been more focused on global container shipping than they are today. Yet the steel of the industry, meaning the ships and the containers, are really outside of U.S. control. And they are consolidated into the hands of an extremely small circle of non-U.S. companies that continue to bolster their market shares. And it reminds me of the old saying, the big keep getting bigger. So let's sum up the situation for everyone. The question we always get at Supply Chain Solutions is, how long will this supply chain crisis last? And in my opinion, it's really about consumer demand that's running very high, and this can only be resolved in two ways: either by consumer demand coming down a bit, or with infrastructure investment increasing. And I think everyone could guess infrastructure investment takes a long time. They can invest now, but it's years away from coming to fruition. So our view is that this supply chain disruption environment is here to stay for some time. I'm sorry to say, folks. And because of this, we're unlikely to see a change in behavior of the various players in the shipping industry. And essentially, there is basically no incentive to change behavior. No incentive for these major players to change their behavior. And there are three main decision-making groups that are steering vessel and equipment pricing and availability: the shipping lines, which offer freight rates and purchase and lease ships and containers; the container equipment lessors, which order new boxes or containers and offer leasing rates; and the container factories, which offer the prices for newly constructed boxes or containers. So only a handful of companies control the capacity in each of these three groups. And in each case, the current market situation is enormous, I can't even say the word, is enormously profitable, removing incentives to compete more on the price. So I did some digging and I found that according to the data from Alpha Liner, the top 8 liner companies now control 81% of global capacity. And it should be noted that prices obtained by shipping lines are extremely high right now, and there is still plenty of cargo waiting to be shipped in Asia. So shipping lines are really in an environment where there is absolutely no need to change their behavior. The same goes for the container equipment companies, virtually all of which are located in China. And over the last couple of months, there was a huge consolidation of the top 3 Chinese builders who produce 83% of all the new containers produced. They are charging expensive prices for their containers, and they have a vested interest in maintaining high pricing levels. So we really can't see why manufacturing prices would drop. And there's absolutely no incentive for these companies that are building these containers to change their behavior. Now, the pattern repeats itself yet again in the container equipment leasing sector. And I found that the top 5 players in the container equipment leasing sector recently consolidated. And I discovered that these top 5 players control 82% of the world's leasing capacity for containers. So again, there is no risk here that the major players would suddenly change their behavior. So adding it all up, it equates to a grand total of just 16 companies. That's 8 liners, 3 factory groups, and 5 box lessors that control over 80% of container ship capacity, box production capacity, and box leasing capacity. And the shareholders of each of these 16 companies would benefit financially if today's pricing, high pricing continues to persist. So think about that for a minute, folks, and let that sink in. These 16 companies control over 80% of the container ship capacity, box production capacity, and the box leasing capacity. So let's talk about ocean carrier consolidation for a minute. Now, ocean carriers have been busy placing orders for new ships, whether directly on their own accounts or indirectly through chartered tonnage ordered by vessel leasing companies, okay? Meaning that some of these vessel leasing companies can charter the vessels, okay? The order book has more than doubled since last year, okay? So the amount of vessels that are being ordered to be built and to lease are off the charts, okay? And the order book has more than doubled since last year, but the new ships won't hit the water until at least 2023 or 2024. So there's really no relief to the U.S. cargo shippers in 2022, okay? So, you may hear about all these ships being built and new, slot charters coming into the rotation. It's not going to put a dent into the available capacity in 2022, folks. So as the new ships are being built, leading liner companies are acquiring secondhand tonnage, secondhand ships, okay, further consolidating their market share. So according to Alpha Liner, the top 8 liners are Maersk, based in Denmark, MSC, or Mediterranean Shipping Corporation, based in Switzerland, the flag carrier for France, which is CMA CGM, COSCO for China, Hapag-Lloyd in Germany, ONE or One in Japan, Evergreen in Taiwan, and Hyundai Merchant Marine based in South Korea. Now, 5 months ago, these 8 carriers had 19.7 million 20-foot equivalent units of their capacity on the water. 19.7 million. Since June, they added 435,236 TEUs of capacity, 20-foot equipment units of capacity, bringing their combined fleet to 20.1 million TEUs, and their market share is 81.1%. So Vanessa is now going to go to our first slide, and we can see that the top 8 carrier groups share a global fleet equaling 81.1%. And you could see, you'll see that Maersk is number 1 with over 4.2 million TEUs on the water. Then we go to MSC with 4.1 million, CMA with 3.1, and down the line, COSCO, 2.95 million TEUs, okay? Hapag-Lloyd with 1.7, and ONE with 1.5. Of course, Evergreen, you could see there at number 7, has 1.4 million. And then rounding that out would be Hyundai Merchant Marine with 826,000 TEU capacity. And all of the other shipping lines, the smaller companies, you know, the Wanhai lines and the SM lines, all the smaller companies combined for a total of 4.6 million TEU. So as you can see, it's a heck of a lot of market share. Now, I think the net gain since June was driven entirely by increases in owned tonnage as opposed to new charters. And the charter market is largely sold out. Okay. I mean, unless you're Home Depot or Walmart, who has the deep pockets to essentially outbid anybody to charter a vessel, you know, chances are you're not going to be able to charter one. Okay. With MSC essentially leading the charge as it continues to buy an unprecedented number of secondhand vessels. And the largest liner companies are set to further increase their market dominance in 2023 and in 2024 when new builds or new vessels are delivered, to the extent that the deliveries are not counterbalanced by the lease expirations and the scrapping of older tonnage. And that scrapping of the older tonnage is a whole nother topic for the ship show, because it's a big business. When these vessels, you know, reach their lifespan, they're often sold for scrap. And that's a huge side piece of business here that would be a great show in itself. But according to my sources data, Maersk order book totals 6% of its on the water capacity. CMA's orders to fleet ratio is at 17%. Hyundai Merchant Marine and COSCO are at 20%, and O&E or One is at 21%. And then you have Hapag-Lloyd at 23%, and MSC, which is far outpacing Maersk and is destined to become the world's leading carrier at 24%. And of course, Evergreen at a whopping 48%. So you can see that MSC and Evergreen are ordering new ships to be built like it's going out of style. And the liner shipping consolidation transpired or happened amid the loss of, amid the loss-making market of the past decade. So setting up surviving carriers to reap the benefits of the COVID era surge in consumer demand is really extremely challenging. Now, it is also important to note that Maersk bought Hamburg Süd in 2017. COSCO, China Ocean Shipping Corporation, COSCO, merged with China Shipping in 2016 and bought OOCL in 2018. Hapag-Lloyd merged with CSAV in 2014 and also bought CCNI in 2015 and acquired UASC, United Arab Shipping Corporation, in 2017. And then CGM bought APL, American President Lines, in 2015. And then NYK, K-Line, and MOL merged into ONE, One, in 2016. And another major competitor, Hanjin Shipping, essentially went insolvent in 2016. So I can tell you, folks, I speak from experience when I tell you that we have definitely seen the effects of consolidation, at least on the main trade lanes. And there is really a de facto monopoly, which means the carriers can somewhat better prevent the price wars we've seen in the past. And this is the logical endpoint of 20 years of gradual consolidation. And all of this brings us to container manufacturing consolidation. So as consolidated as liner shipping is, its market concentration pales in comparison to the box manufacturing sector. And as previously reported on the weekly ship show, container manufacturing is dominated by a small number of Chinese businesses, most of them with ties to the state or the CCP. I have also found that data from the consultancy firm Drury shows that China International Marine Containers, CIMC Group, has a 42.5% share of the H1 2021 production. So that H1 means the first and second quarters, the first half of 2021. Now, the other big box manufacturer, Dongfang International Containers, has a share of 25.5%, and CXIC Group has a share of 14.1% when it comes to container manufacturing. So the dominance of the top three is increasing. Now, Dongfang hiked its capacity in 2019 by purchasing factories from one of the smaller players, Singamas. And this September, CIMC agreed to buy Maersk Containers for 1.08 billion, including their assumed debt. So Maersk had another separate company that actually used to build containers, and basically Dongfang and CIMC agreed to buy the Maersk Container Group that was manufacturing boxes. So this deal is expected to close by the end of the year, giving CIMC another 1.2% of the market share and bringing the top three share in the first half of 2021 production to 83.3%. So think about it. Three companies in the world control 83.3% of all container manufacturing. So Vanessa, if you would be so kind to go to our second slide, you will see that the top three in the first half in H1 of 2021 box production, that equals 83.3%. And you could see number one is CIMC Group, and that includes Maersk Containers, where they manufactured almost 1.5 million, 1,471,000 TEU. Then you could see Dongfang coming in at 861,000 with a 25% share. And then CXIC, number three, manufactured 475,000 20-foot equipment units. And it doesn't even capture the data related to 40-foot containers, high cubes, and 45-foot containers. And all of the other box manufacturers in the world only that it was only 561,000 20-foot equipment units. So again, there are really some staggering numbers. And it's important to note that Chinese box manufacturers are producing a record number of containers this year. For example, Textainer predicted that production would exceed 6 million TEU, while container equipment lessor Triton estimated to be building around 5.4 million TEU. And it should be noted that the previous record, according to Drury, was 4.4 million TEU, or 20-foot equivalent units, built in 2018. So, it's really important to note that China's top three are protecting their pricing and not flooding the market with excess containers. And the cost of a new container remains at an all-time high. So for someone to build one of these companies building a 20-foot equipment unit, they are charging $3,800 US per TEU if you want to buy a 20-foot equipment unit right now. And further, according to my sources, there are only three major manufacturers. So when they can't get enough orders, they prefer to reduce their production and working hours at the factories versus reducing their pricing. And that certainly is a sign that they are not changing their behavior. And that brings us to container leasing consolidation. But before we go on, doesn't that sound familiar? That these companies prefer to reduce their production and their working hours at the factories versus reducing their pricing. It's almost like the container ship lines. As the rates start to drop, they start to implement blank sailings. They start to take vessels out of the specific rotations and strings so they can artificially drive up the pricing again to protect their market share. So, boy, isn't that really interesting? But then again, that brings us to container leasing consolidation. And containers used to move ocean cargo. So, containers used to move ocean cargo are owned by liner companies or by equipment lessors. And it's around 50-50 split. The amount of containers that are used to move ocean cargo, 50% are owned by the liner companies and 50% by the equipment lessors or leasers. Okay. So among equipment lessors, the Bermuda-based company Triton is the largest with 25% of lease capacity, and Triton rose to the top of the pack after a merger in 2015. So Bermuda-based Textainer is in second with an 18% share. Next in line with a 14% share are Florins, owned by China's Costco, and with 14%, the combined holdings of, 14% of the combined holdings of CIA and Beacon. So the owner of Beacon, which is Japan's Mitsubishi HC Capital Company, they acquired CAI for $1.1 billion in a deal that is expected to close this quarter in Q4, and that rounds out the top five. In the last two, is SEACO, okay, SEACO, which is controlled by China's H&A Group, and China's H&A Group is a conglomerate company, okay, that's involved in a lot of different things. They're involved in mining and logistics and shipping, but they have 11% of the market share. So again, it's a crazy situation. And Vanessa, why don't we just go to our last slide, please? And that can kind of give you an idea of where we're at on the last slide, where the top five box lessors or leasers share of what their lease capacity is. So think about it, folks. I mean, the top five control 82% of the lessors market, with Triton at 25%, Textainer at 18%, and Florins at 14%, as well as CAI and Beacon at 14%, and then SEACO coming in at 11%. And all the other smaller container manufacturers or leasers, more importantly, the container leasing companies around the world, that only accounts for 18% more. So again, a really crazy situation. Now, to bring it home, I think it's important that comparing market concentration in container leasing to the liner leasing business and the container manufacturing business is pretty much a similar environment where we have five main players. Just like the container ship lines, there's certain strategic main players, and the leasing companies haven't necessarily gouged customers in terms of the pricing, but lease durations have certainly been extremely positive, and the yields have really been attractive. And the inventory levels for most leasing players are extremely low, with everybody enjoying a utilization rate of 99.9%. So there's no containers out there to lease, folks. It's a heck of a business to be in right now if you're one of these owners. So it would take quite a few quarters until we could potentially see a change in behavior here. But the bottom line, folks, all of this consolidation is going to continue, causing supply chain disruptions and tighter control as the top players tighten their grip to form a monopoly on the services that we all need. And again, this is just another hurdle for us in the great supply chain disruption of 2021. But I know that Jason and Vanessa and all of us at Supply Chain Solutions would like to assure everyone that we will always be here to have the same end state as our clients, our potential clients, and we will help you navigate these turbulent waters and the disruptions step by step. And with that, I am going to turn it over to my amazing Ship Show co-host, Jason Brand, who is going to take us home and talk about the market conditions.
Awesome, Anthony. Hey, I just want to quick give you kudos for that topic because, I think and this is going to be fast, but I think the majority of the time we've been doing this show, we consistently get a question of when do you think rates are going to go back to normal? And what I love about your topic, Anthony, is it kind of shows the direction we've been heading coming up to this point and the concerns going into 2022 and 2023 and beyond. So thank you so much for that awesome breakdown. I'm obviously going to have to listen. I love to listen to our shows again because Anthony's got such great topics. I've got to soak them up. So anyway, thanks again, Anthony.
You're welcome.
All right, let's dive over to the freight market roundup. Okay, we got a new format. Thanks to Vanessa. I love it because sometimes I carry one topic into the next. So I'll try not to go on too crazy, but let's touch on a few things real fast. So first things first, Trans-Pacific eastbound. Let's start off by saying an not so fun fact. So just last week, it was announced that only 10.8% of ships serving the Asia to US West Coast lane arrived within a day of their scheduled arrival window. Now, this is a really big deal. And when you compare that number to the dip in the Asia to US rates we've seen in the past few weeks, I'd say the two are correlated, and I really wouldn't go running to book all your missing inventory levels yet. Another big factor here to consider is that we just broke the all-time high congestion record for ships waiting outside of the twin ports in the West Coast, so LA and Long Beach. Now, last week that was clocking in at around 83. I don't know the current number, but I believe it is higher right now, so keep that in mind. Month over month container volumes from September to October actually rose by 6.6%, yet year over year, volumes are down 2.4%. This is actually down from last year's October of 2020, and they had a record-breaking number of imports at 1.71 million TEUs. But remember, there was no port congestion at that point. Another thing to keep in mind here is while year over year, we're down right now in the Trans-Pacific eastbound, you've got a increase year to date by nearly 20% this year. So that's definitely a factor adding to this congestion. Also, another big factor that's been developing and getting worse is the West Coast has been handling a larger share of the total Trans-Pacific shipments. So this year we saw 61.1% of all the US Asian imports come to the West Coast. Last year, that number was 60.9%. In 2019, it was 60.7%. So this West Coast situation is, obviously the highest in congestion. And the shift to imports coming into the West Coast is, likely an indication of a slow response of importers reacting to the developing market conditions. So I'm going to quick give a nod to us, but you should invest in some visibility tools. You could prevent things like this. You could see the congestion. You could see the change in schedule reliability, and we could edit your shipments faster with your involvement. So keep that in mind. Obviously, this trend is getting worse right now. It's going to be interesting to see where that goes next year. So kind of considering now North America to Asia, going the reverse, and going back to that dip in rates I mentioned. So last week, there's these 4 major aggregate pricing indexes, and 2 of the 4, they showed a severe drop in these prices, but they're not indicating a lack in demand. They're indicating this is due to the power crisis and the production issues that happened in China. So this is being echoed in a few other areas right now. So some of the production decreases are being reflected in the Chinese terminals of Hong Kong, Guangzhou, and Shenzhen. So year over year, there's been a decrease in volume by around 3.4%. And then if you look at September alone at these same terminals, you're looking at another 3 to 4.4% decrease in container volumes. So I know these are single digits, but these are relaying massive changes in numbers, especially when you're looking at the year to date and year over year. So another thing to consider, we do have multiple GRIs coming up. I know rates are high, but do expect those and plan around those. And you've got to remember this lane, the eastbound version as well. They're really ground zero when it comes to container vessel congestion. So it's going to be fraught with issues, whether you're going, to the US or you're going to Asia. So you got to keep that in mind. And you have to book in as far in advance as possible. So when you're shipping this lane, we're seeing people book at the very last minute, and we'll do our best, but we're severely hamstrung if you need a container moving as soon as possible. And that's going to relay into higher costs. So try your best to book as far in advance as possible. We're recommending 6 weeks on both directions of this lane. And if you're needing special equipment, it's very critical. You start working very closely with your partner, with us, and we can help acquire that equipment in advance. Now, kind of considering North America and Europe, so there's a few things going on here to kind of look at just the UN in general, what they've been doing. You've got the United Nations Conference of Trade and Development. They've been trying to assess the damage of these elevated freight rates and what they're causing, and they're predicting a minimum 1.5% increase in consumer price levels between now and 2023. And that was what they said was the minimum. When you dive into the details of it, it gets a little bit more intense. So small consumer goods are going to get hit the most based on their predictions. A couple of the worst hit are like leather goods, for example. They're expecting an over 10% price increase. So keep that in mind. Getting over to the US ports, since the US is dealing with congestion on both sides right now, booking in advance, like I was mentioning, it's got to be a part of your new business process. And I cannot stress this enough. So you got to book at least 4 weeks in advance when you're considering Europe to North America trade. And if you can book 6 weeks, particularly if you're leaving the West Coast or going to the West Coast, you got to keep that in mind. So final note here, the Port of Savannah, final note on this section. The Port of Savannah, it's been through a little bit of a wild ride recently. Reports were saying it was getting better at processing these high levels of congestions they saw about a month and a half ago. But lately, it seems like those reports are kind of flipping what they're saying. And something to consider here is Georgia has been investing a lot of money to fix these problems. But I do think the safest bet is if you can avoid Savannah till 2022, when some of that investment starts to come online, and it should aid a little bit. So let's see here, Europe to North America. So, thinking in reverse, we mentioned this a little bit earlier, but if you're shipping into North America from Europe, you're likely going to be heading through that East Coast, and the congestion in these ports, it's a really frustrating congestion. And a lot of this congestion is due to shippers moving away from the West Coast, even though the facts are stating that West Coast shipping is increasing. But in response to this, we have some good news. The ports of New York and New Jersey just announced they're hiring 500 more people. And this is actually a pretty substantial increase. So the two ports in 2020, they operated, and this is based on, I forget the name of the organization, but they operated in 2020 with 3,300 people. So a 500 person increase is quite a substantial increase. And I did mention this before, but it is critical to remember that warehousing space is tight on the East Coast. So Williams-Sonoma, Bed Bath & Beyond, they've both been taking down a ton of warehousing space, particularly outside the New York and New Jersey ports. So that could be, driving your prices up a little bit more. And then flipping back over to Georgia, they're bringing more than 20 million square feet of warehousing space online before the end of 2021. So, it's good news, but it's not really going to have a big effect on prices, at least yet. You really want to look into 2022, 2023 when you see that, capacity maybe being underutilized. So let's move on to Asia to Europe. So Asia to Europe, when we're heading back over to the Asian shipping market, you've got to remember again that China is in particular dealing with quite a lot of issues currently, and this is affecting their ability to export. So when you add to the fact, and I mentioned this a little bit earlier, that Asia to North Europe, their trade schedule reliability is low. Actually, in September, it was at 22.7%. And then that was close to the record low, which was 22.2%, which was set in July of this year. And that was, when you compare it to last year, July of 2020, obviously we still had issues, but they had a schedule reliability of 91%. So you're really at a totally different world when it comes to shipping in this lane right now. Also, the rates in this lane have grown really tremendously. And, so if you look at November 16th, the average rate, and remember, this is across the board, so this may not apply to you and your volume levels, but it was around $7,500 per TEU. But that's almost quadruple what it was last year at 1,500 TEU per TEU. And then if you go a year before that, $750 per TEU. So definitely painful. You're looking at a tenfold increase in 2 years. Not fun. And you may not know this, but actually when you're considering this lane and the impact of this lane, 30% of the port volume in Hamburg, Germany actually comes from China. So these rates are having a tremendous impact on them, specifically considering, their major trading partners. Yeah, it's a high volume lane. You've got to book in advance and, contact your partner as soon as possible. Let them know as early in the process as possible what's going on. And, we can definitely do a lot more if we know more. So going over to India to North America. So India, North America, it's been getting better, but the main thing, and we're still having a problem with this, is this port of loading omissions. It just drives their schedule reliability down really hard. On the flip side of that, rates have been stable, and you don't see the same rate fluctuations. They are high, but they're stable. You can actually get on board with a freight of all kinds rate. I would not recommend trying, but you can. And but that is decently good to know. They also did just open up their borders to vaccinated tourists, and I'm hoping that will take some of the ocean to air cargo and kind of accelerate that, easing some pressure, lowering some of the pressure on air rates as well. We might be able to see a little bit of help there. Also, they've been having a better success dealing with some of the equipment issues they had. So it is improving. The situation was pretty bad for a while. We had a really hard time dealing with India and shipping out of India for a while, but it is improving. So it's very good to see. Let's move on to our air. All right, Asia. So first off, rates are currently high. You got to remember, in a normal year, we technically left the peak season of ocean shipping. So now we're squarely in, oh crap, I need more. It's the expedite shipping for air shipping. So, when you're considering this, you got to add that Shanghai is still recovering from a shortage of ground handling staff. And while there is very strong demand out of Guangzhou and Hong Kong, it's a tough time, right? Because you still have a lot of people doing these ocean to air conversions that aren't trying to make it into the holidays. They're just trying to restock their inventories. So it is tight out of Asia. And I mentioned this earlier, but China is battling, actually, I didn't mention this earlier. China's battling a huge breakout of the Delta variant right now. It's actually the biggest breakout they've had yet, and it's causing some disruption on the civilian side. So PAX, as you can see here in the comments, that stands for the passenger flights, they are being canceled, and this is particularly due to South China due to the outbreak. This is important to note, since a lot of commercial cargo does generally get tucked into these flights as well. And on the flip side, China did say, and this is in a separate kind of announcement, that they are shooting for restriction-free travel throughout the mainland, and they wanted to start that as soon as December. But we're really going to have to see how this latest outbreak unfolds to see if that happens. Kind of considering Vietnam here for a second. So it's actually been considered stable. It's tight, but it's stable. But you do need to remember that they are still operating at a much lower capacity than they were pre-COVID. So you're not going to get the same service. You still need to book farther in advance.